Welcome to Market Week in Review for the week ending July 28th. I'm Sophie Antel-Gilbert, and I'm joined today by my colleague and friend, Eric Ristevan, Chief Investment Strategist for Russell Investments. Hi, Eric. How are you?
Hi, Sophie. I'm good. Good to see you.
Good to see you, too. It's wonderful to be in the same studio together, too. That's great. I am looking forward to picking your brain, especially around, we want to talk about the Fed. They raised rates yesterday. I'm sure you have thoughts about that. I want to get your thoughts. Second one around China and their recovery numbers that we're seeing out of that and reactions. And then lastly, GDP. We just got U.S. GDP numbers last week, or this week, earlier this week. Would love to get your thoughts on that. Sound good?
Mm-hmm.
All right. So can we go ahead and start with the Fed? We just had interest rates were raised again. What are your thoughts?
Well, to the surprise of 3% of the market, the odds were 97% that they were doing a quarter-point raise going into the meeting. They did a quarter-point raise, a little bit of hawkish language on the back end. I don't think that's particularly surprising. I think that they're very clearly, and they've been clear, and they continue to be clear, that inflation's the foe. Our colleague Bei-Chen Lin wrote a really neat article that kind of compared monetary policy to summer barbecuing, and he talked about barbecuing chicken, and he made it, which I thought was a great analogy. Overcooked chicken is better than undercooked chicken for your health. And so, overcooking monetary policy as it relates to killing off inflation is better than not doing enough to kill inflation. I think that really needs to be how people think about the Fed's inflation fight. Yes, inflation's coming down. We saw core CPI come out at 4.8%. 4.8% is lower than the 5+ it was the month before, and that's year on year, but 4.8 is not 2. And I think really one of the areas, and we've talked about this ad nauseum, and we'll probably continue to talk about this ad nauseum
until we get to 2.
until we get to 2 is, we look at the Atlanta wage tracker. It came down in the latest tick, but it's at 5.6, I think, actually. So 5.6% wage inflation is still too high. The labor market is overheated. For them to be confident that they've actually killed inflation and there's no, burning embers of inflation left in the economy, I think you're going to have to see wages coming down, which means probably they're going to have to see an adjustment in unemployment from where we are today to something that is notably higher, say 4.5%. And that hasn't happened yet. So I think when people think, why are they raising rates when inflation's obviously coming down? Well, we've seen this movie before. There are a lot of fits and starts in the 70s. Even Volcker, saw inflation come down, stopped, his tightening monetary policy too soon. Inflation came back in a flash fire, and he had to stamp it down again and finally did kill it. But he brought interest rates up to a very, very, very high level at that point. So that's really what they want to make sure is they want to make sure not only is inflation trending the right way, they want to make sure that it's getting close to the target, if not at the target, and they want to make sure there's no other kind of things out there that would allow inflation to come back before it was finally killed.
Excellent. So it sounds like they're trying to be very thorough and intentional.
Yeah.
Excellent. Speaking of thorough and intentional, China. We haven't seen sort of the economy pick up quite as much as we thought coming out of the COVID restrictions and stuff. What is the latest there, and what are the reactions from the government?
And Alex Kuzley talked about this in last week's Market Week in Review. It's been a disappointing recovery. It hasn't been anything like what most of the Western countries did. Shouldn't be surprising because they didn't dump giant tons of money from helicopters like the Western countries did. But I think really what I think you're seeing now is the Politburo met, and their discussion point was the economy. And they came out with some statements, and they kind of repledged, and they'd already talked about it. They're pledging kind of more stimulative economic policies. But I think one really important thing that they said in their statement was actually it's what they didn't say. They actually removed a phrase that's been there since 2019, which is houses are for living, not for speculation. They took that out. And I think I think it's kind of an important point because what it tells me is the Politburo is beginning to understand that if they don't get the property sector under control and they don't get healthier property market, they're not going to get consumer confidence up, right? It pretty much, that's not just a Chinese thing. If your house price is going down, you're not that confident as a consumer. And they want the economy to be driven primarily by consumption. But Chinese consumers are hesitant. And part of their hesitancy is they're not sure what their house is going to be worth, right? They're not sure there's stability in the housing market. So I think what you're going to start seeing is they're going to probably city by city, they're going to start removing some of the purchasing restrictions that are there to kind of begin to help the property market. It accounts for more than 20% of GDP, which is not uncommon, right? For a lot of countries, housing is the most accretive economic activity they engage in. So I think it's an important, it's minor. It doesn't necessarily mean a ton of money or a huge stimulus is coming or bazooka stimulus is coming, but I think it's beginning to show they're recognizing some of the key problems, and maybe now they'll start to work to really specifically address those key problems. And the housing market is really the key one in my mind.
Yeah, and sort of taking a different approach to how to solve this. GDP. Last question before I let you go. Back to your desk to scour some more details and data. GDP in the U.S. Where is it going? Where is it at? Where is it headed?
Strong number in the second quarter, 2.4%. Stronger than people were expecting it, stronger than we were expecting. I mean, it was just a good, solid number. Not entirely shocking, because when you looked at kind of the purchasing manager index information, which, we talk a lot about because it's contemporaneous data in the economy. Well, you look at the services sector, it's actually been doing really, really well. Right, it's been well above 50, the demarcation line of expansion and contraction of 50. And that's 77% of our economy is services. So I think people think manufacturing is a bigger portion of the economy than it is. So, so goes services.
It used to be.
It did. Yes, exactly. That would not necessarily in our lifetimes, but yes, it used to be. So goes services, so goes the U.S. economy. So I think that isn't enormously surprising. One of the things I noted in the recent flash PMI that was just released this week is manufacturing actually strengthened, which is predicted, right? Because we've seen some pickup in manufacturing. It's still below 50, so it's still in kind of contractionary territory, but it's getting closer to 50. Services actually declined, and I think that's a kind of a recognition, and that wasn't shocking to us because we've been talking a lot about how quickly the services industry was growing to kind of catch up to where it was pre-pandemic. It's kind of getting in that range now. They're getting close to pre-pandemic employment numbers. So I think something to watch for next week when we see the July jobs numbers are we seeing some softening, some easing in hiring in the services sector? And if we get that might be a signal like to the Fed that we're beginning to see maybe that recalibration of the labor market that they're looking for. It won't be enough to change the picture, but it may give them a little bit better feeling that they're making some headway in reducing the heat in the jobs market.
Terrific. Well, thank you, Eric. Thank you for your insights. That's all we have time for today, unfortunately, but can't wait to have you back again very soon. And thank you for joining us. We'll be back again soon.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.